Gold prices during Dhanteras has smashed around 1.3 lakhs per 10 grams. And even gold is not an instrument which is dependent on demand and supply. It's not like a normal product. It behaves in a different way based on behavior and psychology. And recently, we have seen a decline or a drawdown or a sharp move in the prices. So, what are all the actionables as an investor or a trader you should take before deciding either an entry or addition or exit is what we decode in this session. Hi, this is Ganesh Komma. I'm a financial coach and a stock market mentor. I teach people how to combine fundamentals and technical analysis and take an informed decision in your investment journey. And if you have not yet subscribed to this channel, subscribe to get more insights about stock market investing and trading where you can combine fundamentals and technical analysis. So let's go into today's topic of why gold is increasing, what are all the gold perspectives, why demand for gold does not fall when the prices are increasing as well. So in today's discussion, one of the most important factor which we will decode is gold is not following a demand and supply rules, right? It does not follow the demand and supply rules. It is something else. For every buyer, gold has a different perspective. We will look at what are all the different buyers where gold they are entering into it. It can be like central banks, it can be like financial investors like you and me, who's like you and me, who are acquiring gold in terms of ETFs, Bs, how it will look for a jeweler, right? How it will behave for industries where semiconductor industries, all these sectors where gold is of prime importance. Before we move into the topic, a small disclaimer for all of you. We are like SEBI registered entity, and any discussions, any investment related things, right? Any sector specific or commodity investments, it's purely for educational purpose, right? Do not consider this as any recommendation of addition, buying or selling. I also have a part of my portfolio allocation into gold. So this is not a recommendation for buy, add or sell, and it is purely for educational purpose. And investments into the security market are subject to market risk. Read all the important documents, important relevant information, and then take an informed decision. Use this purely for an educational and knowledge perspective. Now coming to the gold, there is a strange case of rising gold demand, right? The gold demand is increasing. First of all, if you look at a traditional way, generally in most markets, when the price and the demand, right, are one very important entities to watch out. And normally price and demand move in opposite direction. Let's say like petrol is increasing, petrol rates are increasing, right? People drive less. When onion prices are increasing, maybe the demand drops. This is the basic economics, the law of demand. Whereas if you look at gold, even though the prices are increasing, the demand does not fall, because gold is not an instrument where it is consumed immediately. Gold is something where it is stored, and gold is something which will not perish, right? Which will not perish. And that's why gold normally behaves in an opposite manner. And if you look at gold, like in jewelry form, in bars and coins form, or even in official holdings by central banks, they have huge reserves. Now, if you look at jewelry, almost 45%, like 97,149 tons. So these jewelry are something like it is passed on through generations. Normally, they are rarely destroyed. Bars and coins, they are stored in vaults, safes, and even in ETFs, exchange traded fund. Every fund house, right, which releases the ETF, they have to have a physical storage of that, and that contributes around 22%, which is around 48,634 tons. And coming to official holdings, central banks reserves for stability, for hedging, right? And even majority of the central banks post COVID, as a forex reserves, they're increasing more into gold. Almost 17%, which is around 37,750 tons, are in official holdings. And people not only buy gold to consume it, they hold it, and it is stored for years and generations, right? And generations together. Now, if you look at the massive gold stock above ground, and if you look at the mining of gold, almost 216,265 tons are available above the ground as of 2024. And the annual mining, if you see for last year 2024, 3,661 tons have been mined as per the World Gold Council. And if you look at the ratio, stock versus the flow, for every 59 tons held, only 1 ton is added each year, right? That ratio is around 59:1. So almost all of the existing gold which is available is there, because gold is not an instrument which degrades. Now, if you look at all the buyers, the different buyers in gold, now does all the buyers react similarly to gold? The answer is no. And if you see here, we have like different buyers. One, as we have just now discussed, the central banks, right? Central banks like are heavily increasing their exposure into gold, and that too like countries like China, Russia, India, majority of the countries are increasing their exposure. And even the gold price increases, central banks does not care, because they buy for diversification and crisis protection. And even we will go into India, what kind of a reserves they have built up in gold also will go into deep. Financial investors, the second kind of a buyer of gold, they are like fast moving investors who react to headlines, charts, like ETFs, futures, bars and coins for investment, right? All the retail investors in terms of physical gold acquiring, investment into ETFs, exchange traded funds, Bs, benchmark exchanged schemes, futures, all the physical gold, right? Like your bars, coins and all that for investment purposes. And the third buyer of gold is your jewelry buyers, right? For your weddings, festivals, and they are like mostly price sensitive. And here the interesting part is, even the gold price increases, maybe they will not be like heavy jewelry. When the gold prices increases, the heavy jewelry demand decreases. Whereas the small jewelry like gold coins, gold bars, demand will shoot up. And we'll talk about this with numbers. And lastly, the fourth buyer is your technology and industry. Yes, gold has its usage mostly in electronics and even in industrial applications. But yes, the proportion of it is very, very less here. And this segment or this buyer, technology and industry, will not flip the gold price movement, because the exposure is very, very low here because of the price sensitiveness. Rather than gold, silver is used more in industries. But yes, gold also has its percentage in this segment. So if you look broadly, all these groups don't always move together, right? Don't always move together. For every buyer, gold reacts differently. Now what we will do, we will look at each buyer, how it will impact. For example, central banks. These are like price insensitive buyers. And if you see post-COVID, majority of the central banks have been doubling their exposure, especially from 22 to 24 as well, 2022 to 2024. Even though gold prices have been at record highs, central banks kept buying in 2025. And in second quarter of this year, 2025 alone itself, they bought around 166.5 tons they have purchased. And the central banks are shifting away from the dollar. Now, if you see, majority of the central banks, 76% of the central bank expect to have more of their forex reserves in gold in the next 5 years. And if you see, central banks wanted to reduce their share of US dollars going forward. Around 73% wanted to reduce their exposure into gold. And now coming to India, our central bank, right? India's golden milestone, if you look at RBI, our central bank, have crossed $100 billion. And as of October 10th, 2025, the Reserve Bank of India's gold holdings crossed this milestone of 100 billion for the first time. And the interesting part is, gold made up around 14.7% of India's total forex reserves. And this was the highest share in about last 20 years. Even if you look at China, The kind of accumulation happening in gold reserves is like very rapid, right? Is very rapid. And now let's look at the second player, who are the financial investors. And these people, these are like fast movers who follow momentum. And in September 2025, last month, we have seen the biggest monthly ETF inflows ever recorded. And in Q3 of 2025, $26 billion were the inflows, which are again the strongest quarter. And if you compare last September versus this September, 6 times higher inflows has happened this year. So this is the kind of a momentum happening here within the investors, right, into the gold. And now looking at the third player, who are the jewelry buyers. And these are mostly linked to price sensitiveness. So if you go back to the first player, which is your central banks, they are mostly price insensitive. But jewelry are mostly into price sensitive. And here, gold is not just an investment. Gold is it's a product for them. And yes, when the gold prices increases too fast, they enter into lighter designs. And even if you look at the trend, the behavior here, when the prices increase in gold, heavy jewelry drops, right? Means investment into heavy gold ornaments, we see a decline there. Whereas coins and bars, we see a higher demand. We see a higher increase. And now coming to the fourth player, which is your technology and industry, which is like small and cyclical segment. And gold has its exposure into electronics, dental tools, and even technology industries. It is used. But the proportion of exposure of gold into this segment is very, very low. So it will not flip the coin either in the positive or negative only because of this fourth player. But yes, gold has its exposure here, as it is more on the price, because gold is a precious metal at a higher cost. This is being more or less replaced by silver. Now looking at the entire price movement, how this shows up in any market. First of all, your central bank and ETFs, if you see, they don't care more about the short-term price movement, but central banks more or less accumulate gold for safety, diversification, and stability. Now, when the prices push up, big buyers give confidence to the other investors, especially the financial ones who follow the momentum investing. And the rally begins. More buyers create upward pressure. And the retail who steps back, maybe they will, instead of entering into a heavy jewelry, they enter into like smaller exposure like coins, bars, and all that. But still, the spending still rises due to the price movement. Now, if you look at gold, normally gold does not follow the normal prices, right? Gold is not something, it is dependent on demand and supply. It is purely dependent on the logic of belief, and it's more on a psychological, because it does not follow the logic of consumption. And gold for central banks, even though it's like 1.3 lakhs, it's a strategic reserve for currency diversification. ETF investors, it's more or less like a momentum play or an inflation hedge. And for jewelry buyers, when the prices shoots up, they look at it like a lighter ornaments or lighter investment, be it into bars or gold, bars or coins. Now here, if you observe, if anyone tells you gold is overpriced, you have to ask them for whom. Is it for central bank? Is it for ETF investors? Or is it for jewelry buyers? Or is it for investors, right? Because gold behaves differently for different investors. And now, very interesting part, yesterday, when we have seen a report or when we have seen an update from US, when they have announced that the US debt has reached around $38 trillion, whereas 1 year back in 2024, it was $34 trillion. So just in 1 year, from $34 trillion to $38 trillion is the increase. And now you see historical movement of US debt versus gold price. As the US debt increased, the gold price has also seen an increase in the prices. So I'll just give you a data-based reflection of this movement. During 1971 to 1980, when the US debt was around 0.4 trillion to 0.9 trillion, and the gold price was at around 35 to 850 dollars per ounce, as you have seen the movement from 2000 to 2012, when the debt increased, there was an increase in the gold price movement as well. 2020 to 2024, this is the period where the US debt also has increased, the fiat currency, right? They have printed more money. As the more debt increasing has happened, the individuals demand a higher yield, and that leads in lower confidence for dollar. And when the dollar weakens, gold normally shoots up, right? Gold picks up more momentum. And right now, at around $38 trillion, and even the debt keeps increasing, there is a higher propensity of growth in gold as well. Now, the real question to all of us is, let's say if gold hits 1.5 lakhs per 10 grams by next year, or it can reach much faster or much later, would you still buy it knowing that central banks have been accumulating more? ETFs inflows are happening even though the price is increasing. Or would you stay away considering that yes, it has reached to beyond your comfort zone and it is breaching your investment logic? So the answer depends whether you see gold as a product or as a store of value. Are you looking at trading perspective for the short term, for the profit booking, or are you looking as a asset diversification in your portfolio? And someone who wanted to do a little bit more detailed research, recently there was a report released by Morgan Stanley Chief Investment Officer where he looks at gold investment up to 20% of asset allocation also. Earlier it was like 60% into equities, 40% into bonds. Now with the recent Morgan Stanley report where it says 60% in equity, 20% into bonds, 20% into gold. Now just imagine all the big investors or the large investors who are having an exposure of around 3.54% into gold. Once that exposure keeps increasing, once their asset allocation increases, how it will impact the gold price movement. So I want you to let me know your thoughts in the comments. Are you buying gold at current levels, or are you waiting for a correction and then wanted to invest? And also let me know in the comments, what role does gold play in your strategic investments, right? I want you to let me know below in the comments. Okay.